All right, everyone. My name's Andy from the Finding Value Finance channel. I've got with us the one and only Scott from Sow and Reap Capital. Looks like he's missing his banner up top with the Sow and Reap. But so Scott, I want to get you on here. We've got a lot of setups in the market, and
Mhm.
a lot of people they always tell me, and I have gotten this actually quite a lot. It's a head and shoulders top. It's a head and shoulders top. Everybody says this is a head and shoulders. Oil's got head and shoulders. Apparently, everybody has dandruff because we got to be doing the head and shoulders shampoo. It's the dandruff shampoo. It's funny. I hear it all the time, and I'm like, guys, this stuff's undervalued. It's not going to be. I mean, you could in the short term pull back. They're gonna think it's the pattern that's creating it. But first off, let when we go before these big moves, they usually have these like fake head and shoulders, I guess, patterns. I don't think they're technically head and shoulders. Usually an inverted head and shoulders or a regular head and shoulders. They are a topping pattern or a bottoming pattern of a very large move. So what I like to see, and I know I'm turning this into what my opinion is, but we'll go back and forth. What I like to see is like a confluence of events. Confluence means a merging of things come together to create an outlook or a decision or whatever it is. So what I try to find is a confluence of data where you've got like an expensive ratio or a cheap ratio, inverted head and shoulders for the cheap ratio, expensive ratio, and a regular head and shoulders top. And a lot of people, I think, they're like, this is a head and shoulders pattern, and maybe it is. Maybe in the short term it is, but I'm investing for the big long term, big picture view. And if it's a fake out, and it rips higher, then you're out of the stock. So, Scott, number one, we see this pattern all the time. What's the pattern look like? Maybe you can yank one up for us, and what's your opinion on it? These
Okay,
head and
I think we
shoulders.
should do a little bit of a challenge. How many head and shoulders pattern can we find in a massive bull market?
Well, these fake
Because
ones.
I mean, so many fake ones, right? So this is Nasdaq, chart of Nasdaq from 1974, 1976 actually to 2000. Obviously, we were in a massive, massive secular bull market, right? For the entire period. If you look at it, it's a huge run up. But let's see how many fake head and shoulder patterns that we can find. So
And
starting off
and
here, I mean,
the one thing
yes,
I do want to say though is the reason we were in such a big bull market is we were at a very high level of interest rates and we went to a very low level of interest rates. That is the
yes.
driver. The head and shoulders
Mhm.
isn't the driver. That is
So,
humans interacting with each other under certain market conditions. And you can get some short term pullbacks. I understand. But the big driver behind it was a declining interest rate environment with lower growth, lower population growth of the demographic.
mhm. Yep, yep, no, 100%. So here, I'll draw a couple of ones here. So I mean, this, obviously you can see the future now, but here, if we were here, what would you call this? So let's see. This is shoulder, head with the classic textbook lower right shoulder, and then it's coming round. So people must have gone, oh, it's a big head and shoulder pattern, but no. What happens? It's a fake out. Goes boom, and then
And
and
there's
then there's
another,
another little shot,
yeah, another
another
head
one
and
here.
shoulders. Yep.
See, that's a classic head and shoulder. So,
The
oh,
fake
we're
out
going
though.
back down. We're going back down. Nope. Boom. Right. So there are so many fake outs in a bull market that you can't really rely on these patterns. So here's another one here. I mean, if you look at this, got that shoulder, head, shoulder. Well, did we break it? No, we just bounced off the neckline and then went boom again. So you I think we just need to clarify once more that when we look at charts and when we do chart reading, it's giving you potentially a slightly higher probability, but by no means you should take it as a Bible, because it really isn't. And the market conditions that Andy was talking about previously is so much more important than what chart would tell you. And for me, the biggest thing is rotation of money and the flow of money, right? So, and this is why I keep coming back to a big things like use soil divided by Dow Jones ratio, right? Because this will tell me where the money is flowing. So you've got this period here. Look at this. I mean, just look at the big picture. Focus on the big picture. Rounding bottom, big picture stuff. If you look at XOM divided by Dow Jones, for example, which is the biggest oil company, and I
Actually,
always like
if you go back to that chart, it's almost a double bottom,
it is. It is a
like a
double
big
bottom.
massive, yeah, double bottom, massive
It's a
one.
massive double bottom. Let's just take everything.
See, I think this also matters because people are looking at it from a time frame of weeks and months. I'm looking at things from
Yeah.
like
Yeah.
decades. So I
Mm.
think what I don't know anybody who's like a billionaire. If you look at billionaires, like we're talking like guys who actually make a boatload of money. What they do is they have a vision and they have an outlook of like 10, 20 years. And they get in real early, real cheap. They build their company when everything is really cheap, and then they sell it off 10, 20 years when it's like in some bull market. And that's kind of how they do it, and that's how I view things. I don't view things on a week to week basis. I don't think you can make any money
Mm.
having a time frame that short. I don't think you can do anything. I mean, these companies are so volatile. If you put like a 6 or 10% stop loss on some of them, I mean, that's like an afternoon move in some of them. There's no way you can do that. I don't. I mean, no one's going to get within the bottom of every entry point of 6%. I didn't even get within 6% of an SM Energy's bottom. Like you know how hard it is to do that. And this is what you're going to end up. This is what you're going to end up doing. You're going to lose 6% on all your entry points, and you're going to have the stock rip it, all over the place because you can't get within 6% of these volatile commodity stocks. But that looks like a double
Yep.
bottom to me, and it looks like a very
Yeah. So
yep.
it doesn't need to be anything fancy in my opinion. So you all you have to do is okay. So here's the the rounding bottom for the 2000 cycle. So let's just do roughly this. Let's say it looks something like this, right? Maybe it will happen quicker. Maybe it won't. But like I mean, your time frame should really be stretched out to the entire decade of 2020s, right? Because if you draw something like this, then it's 2030. Right? If you had
Yep.
a bull market, if you're
Yep.
fortunate enough to have a bull market like the 1970s, it could happen a lot quicker. But even if you look at this, there was a period of large consolidation here, right? As you can
Yep.
see there. So this could potentially be what we might go through. Who knows, right? Who knows? But that time, it doesn't mean you're wrong. I think Philip Fisher said famously that just because the price went up after you bought it, it doesn't mean you're correct. Just because it goes down after you bought it, it doesn't mean you're wrong, right? Because it's all about, I think, the fundamental drivers behind you that it will ultimately be reflected in the prices, right? And it will be reflected in a big way. The short-term movements, I think we just need to ignore and then just keep in mind what happens during a bull market. And the more charts, the reason why I look at a lot of charts, it helps me settle down riding through this volatility because I know nothing goes up in a straight line. By looking at a lot of charts, by looking at a lot of fake outs, I know that I can expect that to happen during the period that I'm holding the stocks, right? During the period that I'm holding my uranium stocks or gold stocks and commodity stocks. That's what I can expect. And that's why I go through a lot of charts. It's not to try and time perfectly my entry points and exit points. It's to help me ride through the volatility that we are bound to experience. We are bound to experience volatility because it's not free lunch. This stuff isn't free lunch. If it was, then everyone will be in it. Everyone will be making money, and it will be an easy game, right? But there are going to be lots of losers and few very big winners. And I think I'm going for the big, I'm going for the big win through this commodity cycle. So yeah, I mean, lots of fake outs. So I think we went through this FMG chart, but I'll show you again because this is probably one of the most epic runs we've had in a commodity. So if I take you back to the 2000s cycle, once again, let's just zoom right in. Okay, so there was a period here where that was that's a leading pattern, but also some could say that this is a head and shoulder pattern, right?
Yeah, that's what we have similarly in kind of oil right now.
Yes. So this does look a little bit like a head and shoulder pattern. So if you're right here in this zone,
We have it in uranium
you would
too.
have freaked out. You would have freaked out, right? I mean, look at that. It broke it broke below briefly the 200 daily moving average, and a lot of people would have panic sold out of here. But there's a faker, and this is why I think it's so important to understand the fundamentals and the market conditions for this commodity cycle. Because yes, you could be off by a couple of years, and it's simply because this is my strategy, and it doesn't necessarily mean that I'm right or anything like that. But for me, anytime it grinds, my first buy entry point is when it touches and grinds around the 200 daily moving average. Because if you're in a really strong, if you have a really strong flow of money into the market, I mean, 200 daily moving average sometimes is the only place it visits. But, we were fortunate enough to see the majority of the uranium stocks, for example, revisit 200 weekly moving average. And that's really a gift, in my opinion, because that's where you can normally build positions for one last time before you take off. So that's the 200 weekly moving average. And I show it on my channel. But you see this pattern a lot everywhere. So if you look at IXIC, for example, NASDAQ.
Well, one thing else that we could identify is uranium bull markets happen under certain market conditions, period, right? We've never had this gigantic uranium bull market in a disinflationary environment. It's always been inflation, and it's always been rising interest rates or a flat interest rate environment. Where like it's rising and then right after it stops rising. So if that's the case, we have those conditions coming up right now. So we're seeing a pattern and the conditions are coming right in front of us. And people are like, oh, I can't wait. I can't wait that long. I can't wait. I'm like, you can't wait for a 20 bagger? Like, you know how long it takes you to get for a 10 bagger or a 20 bagger or whatever? It takes a very long time to make that amount of money in the period of time that we're going to do it in. That's going to take 10, 20, 30 years in some other companies. And you can't wait a couple extra, like a year. It's
Yep, that's right. So what Andy's talking about is, for example, during the last commodity cycle, oil had its last blow off top while the interest rates were going flat, the Fed funds rate. So it's the Fed funds rate at the bottom and the oil price at the top. And so this is what you saw back in 2000s. So you had a period where it stays flat and then it starts going parabolic. And then as it's coming down, it starts going parabolic as well. But then obviously, when the Fed is starting to lower their rates, it means the bond investors are jumping into bonds, jumping into safety, and the Fed is following that and going, okay, we need to lower rates, and it's a sign of trouble. So this is what happens afterwards. So what we don't want to see, and I say it over and over again, is I don't want to see the Fed starting to lower interest rates because it means they are sensing a deflationary pressure potentially through the delinquencies. But the reason why I don't see that, the reason why I think Fed is still comfortable, I mean, there are always, regardless of where you are. So if you listen to Peter Schiff, for example, right, not knocking him or anything, but if you listen to Peter Schiff from 2000s, straight after the dot-com bubble, he will be bearish stocks all the way throughout. US stocks bearish, US stocks rubbish, US stocks garbage, right? You'll hear that all the way throughout from 2000 to 2008. And then he takes a victory lap in 2008. Straight after the financial crisis, he's like, US is over. US is over. But what did we see? Dow Jones, SPX, S&P, NASDAQ all went on a rampant bull market, right? So there's always going to be bears. There's always going to be people who will say that it's the end of the world because, I don't know if that's the marketing strategy that they adopt, because obviously if you inject fears into people, they will watch you, they'll listen to you, they'll think. I mean, there's actually been a study done. I think it was, I don't know, I've read so many books this year, but there's apparently been a study done where they said the reason why people you will always find bears in a bull market is because apparently the general public thinks you're smart if you're bearish the market. And so people follow you because you think, people think that you see things others don't see. And so natural tendency is for people to think that you're smarter than the rest when you're bearish the markets. And so there are always going to be bears in a bull market. And so I think you just need to be really, really careful. You need to understand the market conditions. And the one thing that I was going to show you is the Fed delinquency rates. I think the Fed is comfortable raising rates right now because obviously if they weren't comfortable, they would be at least slowing down the rate of increase in the interest rates, which they might soon. But it still means we've got years to go. But if you look at delinquency rates on all loans, all commercial banks, we are still sitting right here. I mean, this is the 2008 financial crisis. It picked up quite dramatically leading up to the financial crisis. This gray areas where the stock market dumped. We are still on a downtrend in delinquency rates, which means the risk of the money destruction, the credit destruction in the market is right now still low. And even if it was to pick up, it still takes a number of years before it does lead to a deflationary pressure. So I think just look at data.
I don't think that's going to occur like last time because they were giving out garbage loans all over the place back in 02, 03, 04, 05. We don't have any of that in the system right now. They're all 30-year fixed rate loans with a lot higher credit scores. So I don't see that the same size of pressure in the system as we had in the past. I was reading an article here saying that we have 6.5 million homes that are short for the demographic that's coming up. We're still 6.5 million homes short. Now, the interest rates went up. All it's going to do is delay it. It can't stop that. The people still need homes. The pressure's still there. Now it's just a matter of price. Price, interest rate, affordability. Everyone's priced out. And that's what happens when you have a shortage of homes. You go to an affordability level that is really high. So when everybody says this, I see it all over the time on all these YouTube channels. They say the affordability. People can't afford it. They can't do this. Afford. I'm like, okay, if we have the largest imbalance in the system, it's going to the most unaffordable spot that we can get it to balance the market. It's got to price everyone out. But now, since interest rates went up so fast, it's this big balancing act. And I don't know how it's going to balance out necessarily. So, I mean, that's kind of where I'm at. My thoughts. It's like they're trying to balance interest rates, affordability, and the home prices. We still have, on average, the housing starts are about average, and we still have low inventory. So I don't know where this crash is going to manifest. Yeah, prices are coming off, but we had like a monster year, beginning of 2022 and 2021. It was a monster year. It went up like almost 30% in some areas or greater, 40%. Like that can't last forever. So, I mean, yeah, I understand that. But yeah, I think we're in the sweet spot for uranium and a lot of these commodities. You think we're in the sweet spot?
I think we are. I mean, I think we're in the accumulation zone. Like, I mean, keep saying, I mean, I know we've been saying we've been accumulating for quite some time, but that's just the way the markets work, right? Because you can't really perfectly time it. And the primary example of why you can't time it perfectly is because every chart is different. So even if you look at this Apple chart, for example, and you've had multiple times where in a huge bull market where it came down to the 200 weekly moving average. With this one, this was relatively short-lived, right? Because, I mean, when I say relatively short-lived, it was quite a long time still. So if I just do a date range from when it topped, right, this cyclical top to when it broke out of this range, that's 574 days here. Well, this one was a little bit shorter, right, before it broke out from here, which is why you can't really time it. So 224 days. So, I mean, when you try and forecast, I guess, the exact timing of this, you can't do it. What you can do, though, looking at this chart, Andy, the only thing that I keep saying to myself that you can actually, what's actionable? You've got to look at a chart and go, okay, this is something that's actionable that can benefit me in the long run. What is it?
I've got it. So here's the strategy that you could deploy. Whenever you get away from the 200-day moving average, when there's a big gap between the yellow line and your stock price, you don't want to buy it when you have a large gap. And when that gap closes, you can start wanting to average back in or accumulate more
Yeah,
shares. The way to make money
that
isn't to
that
chase price, it's to chase it when it's down against a support level or breaking out of a trend line or something like that. That's how I would do it in a bull
yes,
market.
yeah, yeah, that's exactly right. So I'll just give you an example, right? So let's say you've had a period where it only really touched the 200 weekly moving average once in this case. Well, twice, kind of twice in this case, and then almost three times here. So my question is, would you have been wrong if you bought a little bit early when it first touched the 200 weekly moving average? No, because your strategy still worked, right? Because your strategy of just buying every time it comes down to 200 weekly moving average worked. Because if you just held through it, look at the reward you would have gotten. That's that's the reward you would have gotten, right? So I think for me, the simplest thing is the most actionable thing for me is just buy on the pullback to 200 weekly moving average. There will be times, depending on the market circumstances or maybe, the sentiment in the markets where it does go below it, pieces below, and then quickly comes back above. I think we might be seeing that in gold right now. So if you look at the gold chart right now, I think
Well,
we've had that slingshot pattern. So we broke below the 200 weekly moving average. I thought that was a massive buy zone, right? So I bought a bunch of, I haven't bought gold stocks in a long time, but I did buy a bunch of gold stocks when it did break below and pierce below it, and it quickly came back up because for me, this now has a pretty good chance that it was a fake out below that level, and now we're above it. So for me, anytime we're around that 20, and here's another question. So would you have been wrong if you bought gold here? Well, probably not. Looking at the price movement right now, it looks like you've done well. So for me, the simplest strategy is take the emotions out and just plan what you're going to do ahead of the price movement. So for me, it is every time it comes down to, okay, well, we're in a strong uptrend. Let's get a bit more shares in uranium stocks, for example, when it's come down to 200 daily moving average. And I've adopted that strategy to buy. And this is not recommendation to buy this particular stock or anything like that. But I will show you what I've done with Elevate Uranium, for example. So I think I said this when first couple of times I came on your channel, for example. But if I take everything off the screen here, so I bought Elevate Uranium when it first came down to 200 daily moving average because I thought that was a pretty good spot. And it seemed like I was pretty right straight afterwards because it went up. But I refused to buy it when it started moving because I'm like, okay, I'm just going to find something else that will come down to 200 daily moving average or even better, weekly moving average. So right now, Elevates it, who knows, right? It might come back down to a lower level. So you might come down to the 200 weekly moving average. But this would have been a great place to buy. Once again, 200 weekly moving average, right? So I think just have a simple strategy in place. Remove the emotions. Just have a plan and take the emotions out. Because for me, the biggest thing is having the strategy. My strategy is to just accrue things that are grinding along the 200 weekly moving averages and just keep accumulating as much as I can while it's below those levels. So
here's two different strategies. I want to get your opinion on it. What do you think the difference of we've got my strategy I think is very similar to your strategy. Just buy it when it's down, hold on, ride the entire bull market. That's my strategy in a nutshell. We've got other people, they say that it's risky to kind of be in stocks. They want to try trading this stuff. So they're like, when it breaks this trend line and you start to get momentum, you can buy it, and then you've got good risk reward levels based off of that. What do you think of that mentality or that strategy? And why do you like it or dislike it?
I just don't think it works. So, I mean, from my experience, it doesn't work. If you read a lot of investment books, I mean, there have been so many cases done. So, I mean, I think simple study is something like 90% of the retail traders lose money. I mean, maybe a little bit less, maybe a little bit more, but the main point is that the majority of retail traders lose money, right? You can't argue against that. And so and I think there's Philip Fisher, for example, who is one of the greatest investors of all time. he says, he come across some very well-known traders in his times, and the fact that they get 3 trades in a row right means they just have a much higher chance of losing all the gains in the next trade. So I mean, there are so many studies done. I think it's pretty evident through the data that trading doesn't work for the majority of retail investors, and I've tried trading before as well. It's because there are so many elders out there who can see exactly where your orders are, and so they will quickly. And the reason why we see so many fake outs today is because the algos know exactly where your stop losses are, for example, and where a lot of the buy orders are sitting or sell orders are sitting. They know exact point, the technical analysis that the retail traders use, like the head and shoulder pattern with the neckline. They draw the neckline. So you'll see so many cases where it pierces slightly below the neckline and it pops back up. It's because the algos, the big money that are running these algo trading programs, are faking you out of the trade and going, okay, retail investor, I want you to sell. So that they drop it, pierce it below a certain level. And you see that through 200 daily moving averages as well. You see a lot of slight pierce and then pop back up. You saw that with the gold chart just then, with the weekly moving average slightly pierced below and pop back up. It's the algos pushing out retail investors. So what would you do if you're a trader and if you follow certain rules like, okay, if it breaks the neckline, I'm going to sell? Or you're going to get faked out a lot and you're going to get wiped out really quickly. And that's why I think for retail traders, it's just extremely difficult to make any kind of money, because you've got to get so many trades right to make the amount of money you'll make just holding on. And the amount of effort and the stress that comes with it, it's just not worth it. I've been through it like maybe 10 years ago. So I've tried many different methods, right? Because I was trading in and out. I went into like trading even more frequently in the futures market as well. It's just a lot of stress, a lot of time, and you can't really enjoy life. So what is the point? Why are you investing in the first place? I think that's the biggest question. If you have no guarantees, for me, it's much easier to study the market conditions and predict the long-term trend, right? Because I think I've used this analogy before. Trading, if you're trying to trade the short term, it's like trying to forecast the next wave that's coming. That the next wave, if you're standing at the beach, right? It's like trying to forecast the next wave or the sprinkles of water, right? But if you're investing for the long term, it's like almost like predicting the high tide and the low tide. Well, how easy is it to predict the high tide versus low tide versus trying to predict how big the next wave is going to be? So that's how I look at it. The market conditions are there. The money flow is very evident if you look at the monthly time frames. So I'll go back to my favorite again. So this is the high tide, low tide picture that I'm seeing. So CCJ, TJI, it's a very clean chart. So if you look at this chart, you know exactly where the tide is flowing. It's got a huge high tide and then low tide, and then it's on its way to high tide, it looks like. So this is much easier for me to forecast than trying to forecast little movements, what it's going to do next day here, right? So that's why I just think investing works far better for most people. And for those of you who think you can trade better, try it. I would encourage you to try it. Maybe you'll need to learn it the hard way. Maybe you'll need to pay your tuition fees, your trading losses. But for me, I've done that, been there long time ago, and it's definitely not for me. Maybe it is for you. Maybe I'm just not a good trader. But for me, just understanding the market conditions, understanding the supply and demand picture, understanding the general market conditions in terms of the bonds money flowing out of bonds, money flowing out of general equities, commodities picking up. We've got heaps of inflation. We've got heaps of money sitting on the sideline, the cash sitting on the sideline. People want to, there are shortages of commodities everywhere because of the mining cycle. For me to just understand that, put that picture, the big picture together, and then just riding through it all is just much easier for me.
And how do you, it's easy for us to say like buy off the 200-day moving average and whatnot, but like, how do you choose your companies? How do you know it's a good company or a bad company? And I think a lot of people have problems with choosing companies if they're going to take specific companies. Would it be better just to buy an ETF, or, like how would you if you don't, I mean, some of us kind of live and breathe this stuff, and other people, they're not going to be living and breathing it. They're trying to look for people to, like give them suggestions or whatever. And we're not trying to give suggestions. We're just talking about, our strategies ourselves. But, you know, if you don't follow the markets that much, you just buy an ETF. Is that the easiest way to do it?
I
Or
think
what?
so. I don't think there's anything wrong with ETFs because obviously you are very much diversified in the sector that you like. So let's say, for example, you like uranium because of the supply demand picture and the supply deficit. Yeah, you can buy an ETF and just do fine. I mean, a lot of bigger investors, because of the liquidity and because they're moving big money around, they do tend to buy ETFs too. So I don't think there's anything wrong with buying ETF products. I mean, if you're willing to put in the time into doing the research, understand the jurisdiction, understanding management, understanding their assets and the valuations and all of those things, yes, I mean, you can probably outperform the ETF by buying individual stocks. But I mean, you could have some losers there too. I mean, you might pick out the best stocks out there, or what you assess as the best stock out there. But then there are always risks with these companies because there could be fraud. There's always that risk. They could, if it's a developer, for example. I mean, if there is risk absolutely everywhere, right? Because by selecting an individual company, let's say you're an oil producer, you might have the explosion at an oil site, and your shares might tumble, right? That's just an example of the risk for an oil producer. And a risk for a uranium developer, for example, could be that, or they say that this is certain, the cost of capital, cost of producing is X amount, and they blow way past that. So that's a risk for the uranium developers, for example. So there are risks that are attached to every single company out there. So by investing in ETF products, you are kind of eliminating or diversifying that risk across a broad range of companies. So I don't really see anything wrong with buying ETFs.
Yeah, I don't see anything wrong either, but I like my individual stocks. I like creating my own ETF. That's really what I
Yes,
do.
yes.
Yeah. So yeah, I don't really have too much else, Scott. I mean, we've got the fake out patterns, kind of how to some basic strategies. If it's something's going straight up, I usually just say nope, not chasing it. I buy things that are down, creating a pattern. They're not volatile. They're in their dead period. You do research on the company, make sure the company's going from a not making money to making money, or they're already making money and they just have a pullback. So yeah, it's I don't know. That's the way that I usually follow things. It's just buy it when it's down, get that dead period. I call it the dead period, where it's kind of like squeezing up somewhere, and then boom, it goes. I usually do pretty well using that method. If you're chasing things that are like up 20% in a day and it's done it for a couple of days, it's kind of like, I'm good. Like it's getting too hot.
Yep.
So you have to get it before the pops, so to speak.
Yes. Yes.
Anything else that you got?
I think it was Peter Lynch that might have said this in exactly right. So don't catch a falling knife. Let the knife fall on the ground, stab the ground, wiggle a little bit, and then you can go pick it up. which is what you see in a lot of the patterns, right? So if you look at URA, for example, it's not really a falling knife. You can't call it a falling knife because what it's really doing is, if you look at this pattern, it's fallen sharply, but then now it's like stuck in the ground, wiggling around this area.
That's a falling sledgehammer there, buddy. I'm just kidding.
So
No,
yeah,
the dead period, it's squeezing up.
This is where yeah, so it's just, this is a dead period. This is what Peter Lynch calls a little wobble or something like that in the ground, and that's when you go pick up the knife, not when it's falling. So for me, that's a wiggle period, and that's why I'm like buying as much as I can right now, whenever I have some spare cash, because I think this is a buy zone, accumulation zone.
Agreed.
And once again, it's not to say that you can't do a false breakdown, right? Because that's always possible. I mean, for me, it's always based on probability. For me, the probability of it doing something like wiggling a little bit further and going up is pretty high. I think I would probably give that the highest probability, right? The next highest probability for me, based on the market conditions, And this is all based on the market conditions and the prerequisites of having the fundamentals supporting a favorable price movement, right? So for me, the next best probability is probably that it does a false breakout and then it pops pretty quickly back above and then goes shooting up. So that's a possibility. The lowest probability for me is that it will go down and stay down. So I don't know, but because this is the highest probability, and I'm not really too concerned about whether I pick it up here or around this area, I just keep buying when it's near the 200 weekly moving average. And that's a simple strategy that I've just learned to adopt, and it completely takes out any emotions because now I know exactly what I'm going to do. My actions are just purely based on what I've planned far in advance, and I just execute without really thinking about it. So
Yeah. I did the same thing buying oil. Like I just saw it come down. I'm like, watch this. It's gonna put in a wick. And it started coming back up. I'm like, I'm in, screw it. Boom, 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 boom. You know, picking up my favorite companies. And here we are with a big wick on the bottom now. I'm like, perfect. And hopefully that's the bottom. It may not be. If it's not, so be it. That's okay. It's still a good price where I got it though. So I'm
yeah.
happy. So I don't know. I that's how I view things though.
I think that's important because you can't really get tied to the price that you pay for it. You've got to always look at the risk reward. And some of the best investors, if you once again, I encourage everyone to, because I think my thinking was that everyone read some, did some reading, but I think you learn so much just reading books, right? And there are so many horror stories where they've missed out on a 20-30 bagger just because you wanted, a slightly better price. And sometimes you just to bite the bullet and pay the price and just hold on, right? Because you have to recognize that no one is not billionaires, no one is going to be able to absolutely nail the bottom. You can get lucky and do it sometimes, right? But it's not possible to do it consistently. So sometimes you just have to say, okay, the price is good enough. This is a good risk reward. Okay, the downside, you say, let's say 30% from here, right? Maximum downside, you think, is 30%. Your maximum potential gain is, say, 30x. Well, you just need to bite the bullet and just go for it sometimes. And recognize, while you buy it, recognize that it can go down a little bit further in the short term. And that's the expectation you build in. And when you build that expectation, you're not going to be disappointed because you already knew that it was a possible outcome from making that purchase. So yeah, I agree. You just sometimes have to bite the bullet and just buy.
Yeah, so sometimes this happens to me. I mistime something, I buy it, right? I usually what I do is if I don't think it's a good buy point, I buy like a small amount, like literally one share. I get it in front of my face, I get it in the portfolio, and then like I'm watching these things, every once in a while, and then I'm like, whoa, this is cheap. And I look at the chart, and I'm like, oh man, it's cheap, it's good to go. I'm like, oh, good, good, good. I can't wait for the next day to open. Then I just buy a bunch. And
Yeah.
and then if it and then it like does like some fake out lower move, and you're like, damn it, it went down again. Yeah. And then am I going to buy more? Screw it. So I just keep buying into it, and I cost average in to get that nice kind of buy when it's really low, and roll higher eventually. Usually that's what happens. It usually turns around and goes. It's very rare where I get like I totally blow it. It's happened before. I mean, I've blown a couple of timing, some ones that I was early in where I thought the majority of the move was done. It's down like 40, 60%, something like that off the top. And then it just drops another like 50%. And you're like, man, you kidding me? I mean, it happened. But you have to understand that it happens to everybody. It's not just you. It's not a bad investment because it went down. It's just some of these are so volatile, like it's part of the game. And then you have to learn that game. If you're going to master the game, it means that mastering the game is mastering the strategy and your ability to identify what to do in certain outcomes. It's not mastering it where you never have down, where your portfolio doesn't go down. It goes down for everybody. It's like, what are you going to do about it when it's down? For me, I buy more. So if I buy a stock at $20 and it goes down to 10, and I'm just making it up, easy math. You're at 20, it goes to 10, it's at a 50% haircut, and it looks like it wants to go back up. I'm like, I'm going in. And if I make a big position, then I got the majority of the shares at $10 instead of the one that I originally put at 20. And other people would say that's a complete disaster. You're out of control. You don't know how to trade. It's this and that. It's like, guys, if you take the big picture view, do you know how hard it is to beat a 10 bagger by trading? Do you know how like it's like impossible for those guys to make a 10 bagger move? It is impossible. So I got a 5 bagger on one of the positions, and I got a bunch at 10 bagger when I bought it at 10. Who wins? Me. I win. And what did I have to do? I had to wait. I mistimed my first buy. So what? It's what do you do after something bad happens or unexpected happens? What's your response? And then I go back to the fundamentals. Is the inventory drawing down? Do we have X? Do we have Y? Is this company making money? Is it still good? What are they saying? Do they have production increases? Yes, 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 yes. Screw it. I'm going in. Sometimes I go in big. If everything looks like it's starting to turn around, that's the difference. I know when to go big and when not to go big. That is really the difference. I know when to press something. I know when not to press something. I know where the support levels are. I know where what's cheap, what's good company, what's a bad company. I know what the fractals look like. I know all that stuff. And that's where I have that confidence to be like, I know what I want. I know roughly where a good entry point would be. And if it gets to that point, boom, I'm loading. I'm loading in. It's a low risk, high reward opportunity. I think I don't know how you could do it any other way. And obviously, you know, if you look at the websites, and I talk about all this stuff with a lot of the question and answer sessions. But I here's a question. Do you think someone can be successful by just watching YouTube? By just watching people talk back and forth?
It's going to be very hard. It's going to be very hard because you don't have your own conviction, right? Because the thing that you need to grow on your own is grow your own convictions. Because if you don't have the conviction, you'll probably quit the first time as a decent drawdown.
Yep.
So I think you need to do your own work. You should, I mean, you can always be open to others' ideas to see, you know, which ones you might want to look into. But I don't think you should be investing like your hard-earned savings out of a YouTube video just
So
because someone said something's good.
In order to get good, what has to happen? Like what I did is I stopped listening to everybody. I'm like, nope, I'm not even thinking about what they say. And then what people do is they say, well, this person said whatever, and this person said whatever. And why are they saying that the market's going to crash? And why about this? And why about that? And they come to me, and it's like, guys, I don't care what they say. Like I am so independent in terms of my thinking that there's people that talk about the dollar milkshake theory, and then they've got the other guy who's like the perma deflationary guy, Harry Dent. That guy hasn't been right ever. And then you've got Peter Schiff, $5,000 gold ever since like 2006, every single year since then. You've got these other guys where they talk about the euro dollar and all this stuff, and that we were going to have deflation. They've been completely wrong. And then you look at all this, and I'm like, guys, I don't care what they have to say. It does not matter to me. I'm so like, other people could come out there and be like, this is a top, blah, blah, blah. I'm like, okay, let's look at the evidence. What evidence do they have? They have no evidence. No evidence. Then they create these big fictitious stories. Oh, well, it's the demand for this and the demand for that. I don't care about demand. Demand doesn't move this. It's the supply of crap. The supply of the dollar coming on moves the markets. That's where your inflation comes from. I don't see periods where it's correlated to a euro dollar and there's this demand that just comes out of thin air. I mean, I don't even understand the argument. It's so stupid. I'm sorry. I'm just going off the a little rant here because it's like demand. I have the demand. If someone gives me $1 million, I'll take it. Is that demand for dollars? If I take a big loan, does that mean there's demand for dollars? I don't know. There's an infinite demand for dollars. The question is, what's the supply? If you look at all the inflation, what do we measure? What's the velocity against the M2 money supply? Supply. It's not a demand-driven case. A demand-driven case is someone that's like saying, Andy, if we gave you a free airplane, would you take the airplane? Yep, I would. Oh, that's demand for the airplane. And it's like, well, yeah, depending on the price, I guess I'd be flying around in a private jet, consuming oil in copious amounts, like everyone would if jets were free. So yes, there's an infinite demand. If you bring a kid into Toys R Us and you say, "Hey, look, do you want the entire store?" They'd say yes. It's all about supply. Supply is your limiting factor. Supply of the toy, supply of the money, supply of what you can afford, how much work you have to put into it to get whatever out. I mean, it's all, in my opinion, that I guess you could say that's in line with says law. Says law is, basically you have to get a job before you can consume. You have to contribute to supply before you can take something out to some degree, unless you just got stimulus money getting piled on. But I just look and I'm trying to figure out how someone can navigate to become a successful investor. And the only way that I can think of is, I mean, you got to find someone who's successful and then figure out what they look at. Like what do they look at? What's the driving factors? Why are you looking at these things? And then you have to start looking at them yourself and starting to understand it. Why do you like this company? Why do you like this chart? And then if you can like tie it all together, like good company, good chart, good market conditions, and it just piles on. This guy's just, all he's doing is he's looking for a total alignment where everything comes in alignment, and you may and it's the time, it's go time. And that's all you can do. You can't force the move. You can't make the market do something it doesn't want to do. You just look for an alignment. Is that kind of a true statement?
Yes,
That's it,
I
right?
think so.
Just alignment.
For me, yes. I mean, because I've been listening to so many people back in the 2000s, right, during the last commodity cycle, it didn't really work out because obviously there were times, in people that I listened to were right, and then times that were way off. And so basically for me, it forced me to study the markets, look at data points. So to the extent that certain YouTubers out there, for example, point to certain data, that's a good starting point because if I didn't know if that data existed, I wouldn't have looked at it. So if I do get the idea that there is that data out there that's available to me, I'll go look at it, back test it, and basically just pile up certain data. Because for me, like, I mean, most important data point that I'm looking at for this deflationary pressure is the delinquency rate, because that is what drives destruction of credit, right? Without delinquency, I mean, it's simple, it's logical, but when you test the data, that's exactly what happened. And anytime there was a delinquency, the markets went down. Everything, all the commodities, everything else plummeted with it. So that's what I look at, like just backtesting data, as much data as possible. And so I'm always open to hear about data that's available. But if I backtest and it hasn't worked half the time, then why would I use it, right?
Yeah, and you have to get the time frames right too, because if you have too short of a time frame, you're gonna associate like, oh, the delinquencies went up. You have to know like where the threshold points are of a lot of these things. So you look at history and you're like, okay, threshold points roughly at this level. You kind of have to like think things through. You have to know what are leading indicators, what are lagging indicators, what are the threshold levels, and what should what should I be watching in the markets. And some of the stuff we go over on the channel, we go over like the Fed funds rate rolling over. That's a bad thing. We look at like housing starts. There's a lot of these things on this channel that I think we look at that are leading indicators, not lagging. You can look at both, but leading is really the ones that I focus on. And then ways to value assets. Could you imagine? Can you get rich without knowing how to value assets? There's no way. There's no way at all. It's impossible. And in order to make money, you have to buy what's cheap and then sell when it's expensive. That's the only way. You can't buy it expensive and sell it cheap. So if you don't know what's expensive and what's cheap, how do you make money? You can't. And you don't know when to hold on and when to sell.
And that's the most important, valuation relative to other assets, because basically it just means all the money's, if the valuation is high, you know that a lot of money is tied in. So this is uranium to Dow Jones ratio, for example. And so if you're looking at uranium here, it means uranium, there was a lot of money in uranium. And so right now, relative to Dow Jones, there's a lot less money tied up in uranium right now, which means there's that much money more available to go into the uranium sector. And so if you look at this chart, this is a beautiful chart, right? So this is a breakout. This is the resistance here, resistance, and then broke out, came back to support. Now it's trying to test the support again. And then, this is, for me, this is a buy zone. Another indication that this is a buy zone.
It's on support. That's why.
Because and it's cheap. It's cheap relative to general equities, for example. So this is what you look at here.
You're saying it's cheap, which is one, and then it's on support, which is two, and you start stacking evidence. You're like, this is good, this is good, this is good, entry point. This is good, this is good, this is good, entry point. It's like it becomes like a rote memory where you get in there and it's like you just look at it and you say, I know what this looks like. Bam, buy it. Oh, this is cheap. I know what this looks like. Good pattern. Boom. You're buying in the tips of like falling wedges and all these different things, which you're combining herd mentality with fundamental analysis, with low inventories, with deficits. It just goes on and on and on. If you know the whole big picture,
right. I mean, it's not just one factor, right? It's everything that you've described. It's the mining cycle. It's the shortages in commodities everywhere. It's the input costs that are going up, the energy costs that are going up. It's the uranium supply deficit that's been, supply deficit that continued from the 1970s or whenever it was. It's everything. It's the money flowing out of general equities right now, out of the tech sector. Money flowing out of cryptos that has to find a place to go. Mm-hmm. It's everything. Everything's lining up, and it's the infrastructure programs. It's the government trying to support the energy sector. It's because obviously when they're supportive of the energy sector, the energy prices go up because that's what happens when governments get involved. So it's a layer of so many different factors that has an input into the final decision-making process.
So your mindset, and this is my mindset, and I don't want to speak for you, but my mindset is there's so much positive, fundamental, underlying structural, like we'll call it the base of some of these commodities. I'm going to say that it's a matter of it has to happen. I just don't know the time. So what we're doing is we're looking at the charts consistently, trying to figure out, is it yet? Is it time yet? Is it time yet? Is it time yet? Is it time yet? And then everybody's asking too, is like, is it time? Is it time? Look, all the things are there for it to happen. They're all there. I don't know the exact timing. We want to all know that. Like we're waiting. We're like, is it time? Like when moon? Like, we all kind of ask that question, and we're sitting here like, it sure looks good. And then somehow, I don't know how they do this miraculously. I say they, like the Federal Reserve or somebody, somehow some of these things haven't gone yet. And I'm like in disbelief. I'm like, man, the inventories are getting low. They are just dropping down. Silver, gold, copper, everything's like asymptotically approaching zero. And I'm like, I am so surprised this hasn't mooned yet. Like I am in disbelief. So as an investor, one thing I'm looking at is like, should I be mad that it hasn't gone up yet? And I'm like, well, not really, because I'm buying a lot more. like I'm actually buying a lot more down here as they're down. So do I want this to go up or do I want it to go down? And then I get confused for a while because I'm like, well, if it stays down for 6 more months, I can buy a lot more in 6 months, of saving and making money and throwing it in there. That's a lot more money. So I don't know. I'm confused if I want it to go up or if I don't. I mean, hopefully something goes up. It looks real fun. You get real excited, but I mean, that's just my mind, my mindset.
I think I'm just happy either way. Like, I mean, I'm happy that I can buy more if it stays down, and then I get excited if it goes up. So it's like, it's happy both ways.
Well, yeah, because I look at some of these positions that I've made in oil and I'm like, man, this is pretty substantial now because it's been kind of down. And same with uranium. I bought some new uranium companies, some that you like as well. And, I'm looking at this and I'm like, man, my portfolio's like, it's pretty beefy and I couldn't do this, a year ago. If it went a year ago, my portfolio would not be nearly the size it is today as I continue to pile in all over this, into the companies that I think are really good. So I'm sitting here looking at some of these positions. I'm like, man, this is a pretty good position side. I like it, And if it stays down another 6 months or a year or something, it's like, so what? I mean, that's my viewpoint on it.
Yep, same.
So I don't have anything else. Scott, you have anything else?
No, I don't. Other than Jesus loves you.
All right. Well, obviously, thanks for coming on. I really appreciate it. And if you guys want to follow Scott, definitely hit him up. He's got a unique Twitter. It's at @U_AG_. And obviously, if you want to follow me, I'm up there too. But we're on Twitter every once in a while. We're firing stuff off. We're putting up chart patterns, um, looking at the herd mentality, see what they're doing, see if we got a bottom. And we're free and open with our comments. I know some people, we may get it wrong every once in a while, and then they try to rip us apart. But you know what? We're throwing up our opinions every once in a while, and I guess that's the price to pay to throw up an opinion. So, but that's all I've got. Thanks for coming on, Scott. Really appreciate it. And
Thanks for having me in,
we'll catch everyone later. So see ya.
everyone.